Most traders think they're reading volume, but they're only reading noise. Richard Wyckoff warned that misinterpreting volume is more dangerous than having no volume data at all. Picture this: Bitcoin surges upward on a widespread candle, and retail traders rush in, screaming, "Breakout!" But if you look closer, the volume is shrinking, not expanding. Wyckoff would call this a false appearance of strength, a move engineered by composite operators to lure emotional buyers before slamming the market back down. The pros sell into that thin volume while amateurs celebrate the pump. And just like that, what looked like a bullish breakout becomes the perfect trap. If you're reading volume wrong, you're not just trading blindly. You're trading against the very operators who built the trap. Ladies and gentlemen, traders and students of the market, today we step into one of the most misunderstood territories in all of technical analysis: volume. Richard Wyckoff taught that volume is the voice of the market, the only element that cannot be faked, delayed, or disguised for long. Yet, despite its power, most traders interpret it backward. They chase rising candles on falling volume, panic, sell on healthy tests, and misjudge absorption as weakness. These mistakes aren't accidental. They're the very traps Wyckoff warned us about a century ago, still claiming accounts every single day. In this talk, we're going to cut through the noise and uncover exactly why traders read volume wrong, how the composite operator manipulates volume to deceive crowds, and the simple, timeless principles that allow you to see the market with X-ray clarity. By the end, you won't just look at volume. You'll understand its intention. Because once you grasp Wyckoff's truth, the charts stop confusing you, and the market finally starts making sense. In Wyckoff's methodology, few concepts are more dangerous and more misunderstood than false strength volume. This is the illusion of bullish power on the chart that convinces traders a trend is strong when, in reality, it's running on fumes. Wyckoff warned repeatedly that the market often looks strongest at its weakest point, specifically because the composite operator (ZCO) designs it that way. False strength volume is not just a misread, it is an intentional trap. It's how smart money sells at premium prices while the crowd buys out of excitement, emotion, and fear of missing out. False strength volume typically appears during the late stages of an uptrend, inside a distribution range, or during a manipulated breakout attempt. The hallmark of this trap is simple price rises, but volume does not confirm the move. Many amateur traders see a large bullish candle and instantly assume bullish continuation. Wyckoff would tell you the opposite. A widespread candle on declining volume is a red flag, not a green light. It means demand is not driving the move. Instead, supply is quietly increasing while participation from genuine buyers is fading. The CO uses these moments to unload inventory onto unsuspecting breakout traders who think the trend is accelerating. An example makes it clearer. Imagine a market pushing up toward a resistance level that has rejected price multiple times. Suddenly, it punches through the resistance with a wide bar. Social media screams, "Breakout confirmed!" Retail traders jump in, but the volume tells a different story. Instead of surging, the volume is light to moderate, far lower than previous impulses. Wyckoff would call this effort without result, a sign that the breakout lacks true institutional commitment. A few candles later, the market collapses back below resistance, trapping breakout traders and providing smart money with liquidity to sell further. False strength volume is also common during upthrusts, UTs, and upthrust after distribution UTAD events. These are classic Wyckoff traps where price briefly spikes above a trading range only to reverse violently. The key to detecting these traps is always the same: the price gain is not supported by commensurate volume. When the CO executes an upthrust, they push price just high enough to trigger stops, lure breakout buyers, and collect liquidity. But they do so with minimal effort. If volume doesn't swell during the breakout, it means the move is engineered, not demanded by the market. Why do traders fall for false strength? Because most focus on price, not volume. Price is seductive, big candles feel powerful. Yet Wyckoff taught that volume is truth. If price moves without volume, it is a shadow, not a force. False strength volume exposes the emotional bias of the crowd, excitement near highs, panic near lows, and a persistent desire to chase what looks strong. Mastering this concept gives you a massive edge. You stop buying tops, you avoid traps, and you begin to see the CO's intentions clearly. False strength volume is the market's warning siren, and once you learn to recognize it, you stop becoming its victim. In Richard Wyckoff's teachings, understanding the composite operator's CO'd is the key to mastering market structure, price behavior, and volume interpretation. The CO is not a single trader. It represents the collective actions of large institutions, informed professionals, and market makers who operate with scale, strategy, and psychological mastery. When Wyckoff said the market is a battlefield, the CO is the general orchestrating the war. And nowhere is their influence more visible than in volume manipulation, the subtle and deliberate shaping of activity designed to bait, trap, and transfer liquidity from the uninformed to the informed. Most traders mistakenly picture manipulation as overt or chaotic, but Wyckoff taught that true manipulation is elegant, patient, and nearly invisible until you learn to read it. The CO doesn't simply pump or dump, they engineer the environment, building trading ranges, absorbing supply, creating tests, performing shakeouts, or launching deceptive breakouts, each move coordinated with carefully controlled volume. They know retail traders obsess over price action, but often ignore volume. So the CO uses volume as a coded language, revealing their intention only to those who understand Wyckoff's principles. For example, during accumulation, the composite operator quietly buys large quantities of shares, but they do so strategically. If volume becomes too obvious during this phase, the crowd catches on and prices rise prematurely, so the CO accumulates on down bars, tests springs and moments of fear, using temporary weakness to hide their strength. Volume may spike on shakeouts or capitulation events, signaling absorption, yet overall ranges remain contained. This controlled environment is deliberate. It keeps the public pessimistic, while smart money positions itself early. During distribution, the manipulation becomes even more psychological. The CO sells into strength. Their strength, your excitement. They engineer rallies, fake breakouts, and create the illusion of unstoppable momentum. But if you watch volume closely, you'll see the fingerprints of the operator. Supply appearing on up bars, declining volume on rallies, and sudden climactic surges followed by stalling price. These are not accidents, they are orchestrated liquidity events. The goal is simple: unload massive positions at premium prices while the public believes the bull run is still healthy. One of Wyckoff's favorite examples of CO manipulation is the upthrust after distribution UTAD. This trap is volume manipulation at its finest. The composite operator pushes price slightly above resistance, not because they expect continuation, but because they want breakout traders, FOMO buyers, and stop losses from shorts to provide the last wave of liquidity. The volume during the move is often not proportionate to the size of the spread, a dead giveaway. Once the trap is set, price collapses. What looks like a breakout is actually the final distribution. Another powerful form of CO manipulation is the test. During a downtrend or reaccumulation phase, the composite operator will momentarily push price down to check if supply remains. The key signal, extremely low volume, that absence of activity tells the CO that sellers are exhausted and the path upward is clear. Retail traders often misread this as weakness, but Wyckoff taught that low volume tests are some of the strongest bullish signals in the entire methodology. Understanding CO manipulation transforms your trading. You stop reacting emotionally and start reading intention. Instead of getting trapped, you begin anticipating traps. Instead of buying strength and selling weakness, you learn to evaluate who is behind the move and whether volume supports the story. Once you see the market through Wyckoff's lens, the composite operator ceases to be the enemy and becomes your guide. In Wyckoff's methodology, few distinctions are more crucial and more frequently misread by traders than the difference between absorption and exhaustion. Both involve volume changes, both occur at key market turning points, and both can look deceptively similar on a chart. But Wyckoff insisted that understanding this difference is the line between reading the market's true intention and falling straight into traps set by the composite operator. Absorption signals strength hiding behind apparent stagnation, while exhaustion signals weakness disguised as effort. They are opposites, yet to the untrained trader, they appear almost identical. Let's begin with absorption. Absorption happens when the composite operator is actively loading or unloading large positions while preventing the price from moving too far in the natural direction. Imagine a market in an uptrend approaching a resistance zone. Price moves into the level, but instead of being immediately rejected, the candles become narrower while volume increases. To the inexperienced trader, this looks like the market stalling, possibly weakening. But Wyckoff taught that this is often strength, not weakness. The increased volume represents significant buying activity from the CO, who is absorbing the supply being dumped by sellers at that price level. Their goal is to prevent a sharp breakout too early, which would alert the public and cause price to rise before the CO secures their full position. Absorption is a quiet battle between smart money and the market's remaining supply. When absorption completes, the move that follows is often explosive because the obstacle, excess supply, has been completely removed. Absorption can also occur during reaccumulation phases where price consolidates after an uptrend. Here the CO buys heavily on down days, holding the range intact. Volume on the declines often remains elevated while volume on rallies may appear moderate. This pattern confuses retail traders into thinking the market is losing steam. Yet Wyckoff pointed out that heavy volume on down moves during a trading range is one of the clearest signs of institutional accumulation. The composite operator is quietly pulling in shares, absorbing all liquid supply before the next markup. Exhaustion, on the other hand, is the complete opposite. Exhaustion happens when a trend has run out of participation, buyers in an uptrend or sellers in a downtrend are depleted. The market is still moving, but the volume no longer supports the movement. Wyckoff famously warned that price without volume is a shadow without substance. When an uptrend pushes higher on shrinking volume, traders must be on alert. This is not strength but imbalance, a clear sign that demand is fading. Exhaustion precedes reversals because once the dominant force loses energy, the opposite force takes over with dramatic results, long wicks, failed breakouts, and eventual climactic reversals. A classic example of exhaustion is seen in a late-stage rally approaching distribution. The candles may still be green, but each step higher comes with lower volume. Retail traders interpret this as calm bullishness. Wyckoff interprets it as a dying trend. Without robust demand, the market has no foundation to support continued upward movement. This creates ideal conditions for the composite operator to execute upthrusts, fake breakouts, and bull traps. The key difference: absorption, high volume with limited price progress, strength preparing for continuation. Exhaustion, low volume with continued price movement, weakness preparing for reversal. Once you master this distinction, you no longer mistake strength for weakness or weakness for strength. You begin to read the market's true intentions, not its illusions. In Wyckoff's framework, climactic action signals represent the dramatic turning points of market behavior, moments where emotion, volume, and price collide to reveal a powerful shift in control between buyers and sellers. These signals often appear at the end of major trends, marking either the final surge of demand in an uptrend buying climax or the final wave of panic-driven selling in a downtrend selling climax. Wyckoff emphasized that climactic action is not subtle, it's loud, violent, emotional, and unmistakable. If you know what to look for. The mistake most traders make is interpreting these signals as signs of trend continuation rather than imminent reversal. To understand climactic action, start with the buying climax, a BC. This event happens after a prolonged uptrend when the market suddenly accelerates upward in a near vertical movement. Candles are wide, spreads are large, and volume explodes. Retail traders interpret this as unbreakable strength. They rush in, afraid of missing one last push. But Wyckoff taught that this surge is actually the final discharge of demand, not the beginning of a new rally. The composite operator uses this emotional surge to dump massive amounts of their holdings onto the public at premium prices. This is why the BC often includes huge spikes in volume. It reflects huge selling hidden beneath the appearance of unstoppable buying. Immediately after a buying climax, the market typically enters an automatic reaction as demand evaporates. Prices fall sharply because buyers have been exhausted. This first drop after the BC is not random. It is a structural part of Wyckoff's distribution process. Following the AR, the market often forms a secondary test, ST, where price revisits or approaches the climax area, but on significantly lower volume. If the ST fails to make a higher high or shows noticeably weaker volume, Wyckoff traders recognize this as confirmation of a completed climactic top. Similarly, in downtrends, Wyckoff identified the selling climax as seed, a violent, fear-driven collapse where price plunges rapidly and volume surges to extreme levels. Retail traders panic sell, believing the market is headed to zero. But the composite operator views this moment differently. It's the final capitulation where weak holders give up their positions at giveaway prices. Massive volume at this point reflects aggressive buying by the CO, not continued selling. After an SC, price usually rebounds sharply, forming the AR in the opposite direction. This rebound shocks traders who just sold the bottom, reinforcing Wyckoff's principle: climaxes mark the end, not the beginning of a move. One of the most misunderstood climactic signals is the volume climax, a singular bar where both spread and volume are abnormally high after a long trending move. This is the market screaming that the prevailing force, demand or supply, has reached its terminal point. Wyckoff urged traders to watch how the market behaves immediately afterward. If the next bars show reduced volatility and a lack of follow-through, it's a powerful sign that the climax was genuine. Another important element is the change of character, CH. After climactic action, the market behaves differently. Its personality shifts. Trends that previously moved smoothly begin stalling, reversing, or showing sudden volatility. Wyckoff traders use this to confirm that the climax was a major turning point. Climactic action signals protect traders from buying peaks and selling bottoms. They teach you to read the emotional extremes of the crowd and the strategic precision of the composite operator. Once you learn to spot these signals, you stop being a victim of market theatrics and instead become a reader of market truth. At the core of Richard Wyckoff's entire market philosophy lies a foundational truth: price only moves when supply and demand are out of balance. This is the engine of all market behavior. Every rally, every decline, every reversal, every trap. Yet most traders misunderstand this principle. They treat charts as random patterns or emotional reactions, ignoring the underlying forces that create those movements. Wyckoff taught that if you can learn to read the supply-demand imbalance, you can predict market behavior with clarity long before the average trader even notices what's happening. To understand this concept, let's break it down. Demand is the presence of buying pressure, supply is the presence of selling pressure. When demand exceeds supply, price rises. When supply exceeds demand, price falls. When the two forces are nearly equal, the market moves sideways in a trading range, simple in theory, but complex in execution. Because you cannot simply see supply and demand directly, you infer them from price spread, volume, and the quality of price movement, the three elements Wyckoff emphasized for decoding imbalance. One powerful example of supply-demand imbalance is seen in rallies with narrowing spreads and declining volume. The average trader sees green candles and assumes strength. Wyckoff sees shrinking demand. If price continues rising but the volume dries up, it signals that buyers are no longer hungry enough to sustain the move. The imbalance is shifting. Demand is weakening, supply is waiting to strike, and a reversal is often near. The imbalance reveals itself before the market turns, if you know what to look for. The opposite happens during downtrends. You may see heavy selling pressure driving prices lower, but as the decline continues, something changes. The bars narrow, volume decreases, and price begins to struggle to make new lows. To an emotional trader, this still appears bearish. To Wyckoff, it signals depletion of supply. The sellers are drying up. This shift often precedes a spring, a reversal, or a reaccumulation phase. When supply becomes exhausted and demand quietly steps in, even a small spark can reverse the trend dramatically. A more advanced manifestation of supply-demand imbalance occurs during shakeouts and springs. These events are designed by the composite operator to momentarily overwhelm demand by creating artificial supply, pushing price below support to trigger stop losses and panic selling. The spike in supply is temporary, but the imbalance gives the CO a perfect opportunity to absorb shares at a discount. Once the forced supply is consumed, demand takes over and the market rallies sharply, leaving trapped sellers behind. Wyckoff considered springs one of the clearest expressions of imbalance, flipping from bearish to bullish in a single moment. Distribution phases show the imbalance in reverse. Price may still drift upward, but volume tells a different story. Heavy selling appears on up bars, signaling that supply is dominating even while price rises. This contradiction is not random. It's the composite operator offloading inventory into strength. The imbalance is subtly shifting, setting the stage for a markdown long before the public sees the drop. Ultimately, supply-demand imbalance is the heartbeat of the market. It explains why trends accelerate, why they stall, why they reverse, and why traps form. Mastering it allows you to read intention, not illusion. You stop reacting to surface movements and start understanding the forces beneath them. And once you read the market the way Wyckoff intended, through the lens of imbalance, you begin trading with confidence, precision, and true insight. In closing, remember this: the market is never random, it is always intentional. Wyckoff's teachings reveal that every candle, every surge, every pullback, every trap is shaped by the underlying relationship between supply, demand, and the composite operator who orchestrates them. The fatal mistakes traders make with volume don't come from lack of intelligence, but from lack of understanding. They chase false strength, fall for manipulated moves, misread exhaustion as weakness, and overlook the climactic signals that shout a trend is ending. But once you begin interpreting volume the way Wyckoff intended, as the market's true voice, you step out of the crowd and into clarity. You stop reacting emotionally and start trading with purpose. You see absorption, manipulation, imbalance, and intent long before others do. And in that moment, you transition from being hunted by the market to finally understanding how to trade alongside the forces that drive it.